You've probably heard by now that Kamala Harris wants to impose a wealth tax if she's elected president in November, but social media is pretty light on the details. So let's dive into the wealth tax and see what it's all about. The tax is a 25% tax on income, but it's inclusive of unrealized capital gains. And it's important to note that the tax is only applicable if your wealth is greater than $100 million. Now, you might be wondering, how would the IRS even have this information? And it's a good question. Taxpayers that meet the wealth threshold would be required to report to the IRS on an annual basis the valuation of all of their assets. Tradable assets are easy because it's public stock, public markets. But non-tradable stock is where it gets kind of interesting. Non-tradable assets would be valued using the greater of the original or adjusted cost basis, the last valuation event from investment, borrowing, or financial statements, or any other method as approved by the Secretary. A taxpayer is considered illiquid if more than 80% of their assets are non-tradable. And these taxpayers can make an election to opt out of the tax, but they're going to be subject to a 10% deferral charge, which I read as a penalty whenever they liquidate the non-tradable assets in the future.